Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, we are in early to mid-March, and obviously we've seen the risk-off asset trade. In other words, the equity markets have pulled back quite a bit, particularly the NASDAQ. Other asset classes, for example, like cryptocurrencies, have pulled down quite significantly. They're in their own bear market. So we've seen the risk-off trade, if you will, occur. So I wanted to give you some perspective on where we are in the equity markets, and in particular, is the market going to continue to correct? How much worse will things get if they do get worse? Of course, there's concerns, obviously, what's going on overseas with, the Russian and Ukraine situation. Obviously, there's high gas prices. Of course, we've seen our bout of inflation. So where are we in the cycle? We'd like to just give you some perspective. So how much more will stocks drop if they do at all? Many folks have heard of a indicator commonly known as the Buffett indicator. Well, the Buffett indicator, which is what you're looking at now, measures the total U.S. equity market capitalization, so the total value of all U.S. stocks divided by nominal GDP. You may recall that GDP, or gross domestic product, is basically all of the value of goods and services produced in an economy. So again, this equation or ratio, known as the Buffett indicator, total U.S. market cap divided by GDP. So where are we in that in terms of a historical perspective? Well, at the end of last year, at the end of 2021, that ratio was a 2.82. Now, how does that compare historically? So traditionally, over the peaks and valleys since 1945, when we started measuring such a ratio, was 0.78. So again, the average over a long period of time, over 70, 80 years, was 0.78. At the end of last year, we were at 2.82. So about 4 times the overall average. At the peak of the dot-com bubble, if you will, in 2000, that ratio was 1.8. What's the value of this ratio? It gives you an idea of overall market capitalization. In other words, the overall fair value of stocks. Are stocks cheap? Are they expensive? Are they average? So if the average, if you will, is 0.78 over the history of the market, at least since 1945, and we're at 2.8, one would conclude that on a relative basis, stock prices are 4 times higher, at least at the end of late last year, 4 times higher than average. Now, does this mean that the equity markets must continue to drop to get back to average? Now, no one really knows what the future holds, but the things like quantitative easing basically is printing of money. We all know that. That effective process, was around many decades ago. So it's very difficult to look at the past and necessarily say it must equal the future. But the past, as we often talk about, does tend to rhyme with the future. So it's important to have some context of where we are in the market cycle. So I just want to get back to this because this is important. Again, this ratio just helps us understand the total valuation of stocks on a relative basis. So according to this Buffett ratio, stocks are quite highly priced. Now, of course, you may have seen these videos in the past. This is the market as defined by the S&P over the last 25 years. Far left, you have the dot-com run, the mid to late 90s, and then we had a big, sell-off from early 2000, 2003. Then we had the big run-up. And then, of course, in the middle of the screen, you had the financial crisis where the S&P sold off over 50% from the high. And obviously, we've had a very good run-up since. And here we are. If you look in the upper right-hand corner, this is where we are now. Now, that white line, that just gives us an indication of where we are versus, let's call that white line the mean. So where are we right now? We are way above, according to the right side of this chart, the market's way above what we would term as the average, as indicated again by things like the Buffett ratio, where total stock prices on average are quite expensively priced on a relative basis. Now, again, you may have, if you watch these videos, you heard us talk about in January of this year, the S&P was 48% above this moving average. Now, by comparison, at the peak of right before the financial crisis, the equity markets were around 30% above this average. And again, in 1999, right before the dot-com crash, we were 64% above this average. Now, let's fast forward to now. Of course, we've seen the market take a bit of a correction / depending on what stocks you're in, potentially even a bear market. We are about 32% above the average. So typically, when the market is too far stretched above an average, whether it's stretched on the upside or above this white line, or whether it's stretched on the downside, you tend to get a correction to the opposite direction. So again, if the past is not indicative of the future on a 1-to-1 or 100% basis, things tend to rhyme. So this is the same S&P chart over a longer period perspective. The previous chart was over the last 25 years. This is from the late 20s. And what I want you to note is basically the consistency. Again, on the far left here from 1929 to 1952, when we had a big run up, as evidenced by the far left side of this chart, we had in this box, a very bad period of, a downturn, let's call it consolidation, where the market effectively went nowhere. So again, when the market has a big run up, we tend to see a very long period of consolidation. What happened from 1969 to 1979? Notice from 52 to 69, the market had a very big run up. So again, following that, we had a very long period of consolidation and effectively a sideways market. From 2000 to 2013, we had what we term as the lost decade. So again, that period of time, after that large run up from 1979 to 2000, we had a period of consolidation and again, a lot of negative markets. Now, I'm not suggesting that, again, the past must equal the future, because things are a little different now. Again, primarily because the Fed is quite committed to continuing to stabilize the financial market, the banking system, keeping interest rates low. But what I am saying is it's very important to have an idea of where we are in the stock cycle, and having history be our guide to what might happen in the future. We, obviously we manage money for clients, proactively. We started protecting or hedging back in September because we understand what the charts tend to read. We knew where the risk was, and not that we were going to end up being right, but we saw there was more risk than we wanted to take. So we started taking measures to help reduce the risk, and it's paid off. So my message to you is, if you're managing your money, you're on your own, or you're with an advisor, our message to you is you need to have a game plan so that if the past does equal the future and we are at the beginning stage of a bear market, if things get worse, you have to have a game plan to protect your money. Going into a situation blind is not ideal. So again, have a game plan to protect your money and have a strategy if the markets do get worse to protect your wealth, right? Especially if you're nearing or in retirement. To that end, if you would like a second opinion on your portfolio, again, just to get a second opinion for potentially some peace of mind of where we are in the market cycle, how it applies to you, and again, if you are in the right investments to continue to weather this storm, if it does get worse, you could send me an email, cnichols@nicholswealth.com, or go on our website at nicholswealth.com to learn more about what we do. In the meantime, thanks again for watching. Have a great day. Bye-bye.